we're going to talk about the commercial property exemption for self-managed superannuation funds. So in my accounting practice, a lot of our business owners actually own their commercial premises they trade out of via their super fund. It's been a very, very popular strategy for a long time because your super fund doesn't have the same restrictions around commercial property that it does with residential property. So if you own a commercial property, your self-managed super fund can actually buy it from you. As long as it's done at market rates, that's fine. You can also be the tenant of the commercial property that your self-managed super fund owns. So commercial property actually in a self-managed super fund is a lot more flexible than for residential property and always has been. For a business owner who's using the premise that's purchased, it can also be an effective way of getting additional funds into super and reducing their taxable income outside. So if we can go to the first slide, please. So the myth, super borrowing is dead. The government killed LRBA for property, full stop. So that is a misconception. What has been banned is the use of limited recourse borrowing arrangements for residential property, but specifically only residential property. So commercial property is still very much allowed. There's no exemption and there's actually no change at all in the use of an LRBA arrangement involving commercial property within a self-managed super fund. So with that in mind, the LRBA arrangement with superannuation is still very much alive. It just simply isn't available to residential property anymore. So we call it the business real property exemption, still very much intact. Still legal under the SIS Act and always has been, and it's a lot more flexible than what we had with residential property. Banks are still very much lending to commercial property investments and providing LRBAs for it. 60 to 65% LVRs is pretty standard for commercial premises. If you're a business owner,
hang on, Matt, you can go even up as high as 80% on select assets.
Yeah, for sure. Yep. And so, yeah, lenders vary, but, you know, generally speaking, commercials 60 to 65. Yep. But you are quite right. Some assets, the lender will go to 80.
Yep.
If you're a business owner, you can buy the commercial premise, you can rent it from your SMSF, and you can be the tenant of that business premise. Your SMSF can rent it to you on all the same commercial grounds that you would undertake any other commercial lease. So it is quite within the rules for the tenant to pay into the SMSF all of the outgoings, like with a standard commercial arrangement, plus rent. So effectively, you can be reducing your taxable income externally to your business by paying into your SMSF and building up your retirement savings that way. It's basically the last remaining way to gain the highest level of leverage with self-managed super. So it's a very, for those people that are wanting to invest their superannuation into property, commercial arrangements are definitely a highly effective way of doing that. We can go to the next slide. Okay.
Sorry, could I interrupt? What is the maximum LVR on commercial potentially achievable?
Look, broadly speaking, it's about 60 to 65, but as Brendan has highlighted, it can be as high as 80%. It just depends on the lender and the asset that you're purchasing. It's just, it's a case-by-case basis. Broadly speaking, 65%, but sometimes higher. So what qualifies? Office space. So you can buy professional suites that are either the whole building, strata titled, medical consulting rooms. Industrial and warehouses are probably the most common for a couple of reasons. Basically, they require very little upkeep. they're fairly cheap, so they're easy for people to buy with their super. And a lot of people that start SMSFs do tend to be tradespeople. They buy a workshop or a storage facility for their gear. And so industrial and warehouses tend to be pretty popular assets. Retail premises are pretty common as well. Probably most accountants in the country own their premise through their self-managed super fund. Other popular ones are gyms, showrooms, and trade counters. Restaurants also. Medical and health clinics are certainly allowable. The challenge with those is they tend to be, you need a lot more money, basically. They're quite expensive assets. So you need a lot more super to put together to purchase one of those. And as I said earlier, strata commercial. So you can get strata title suites, etc. If we can go to the next slide. Okay, so related party acquisition exemption. Under the old rules, actually under the current rules for residential property, if you've got the cash to do it in the super fund, you cannot buy a residential property from a member of the fund. That's just excluded. Commercial property is completely different. You can most certainly buy a commercial premise. Your super fund can buy a commercial premise from you, no problem at all. It's all legal and tax effective. There's no real trick to that. It just has to be done at what's called an arm's length basis. So it's got to be sold from you to the super fund at commercial rates. Consequently, if you're going to rent it back from your super fund, that has to be done at commercial rate as well. It's always best just to get a market valuation from a local agent. I find most agents will give you a commercial, indication of market rents for a couple of $100. So it's not an onerous task. Obviously, commercial rents are a deduction to your business, so it's tax effective on both sides of the equation, because the rent that goes into your SMSF is only taxed at a maximum of 15%. So it's very effective from that point of view. You get a 25% tax deduction in your company by paying rent into your own super fund, and instead of it being taxed at your marginal tax rate, which could be as high as 47%, it's only taxed at 15% inside of super. If you're a business person in your 60s and you're doing that and you've started a transition to retirement pension, then you can pay your rent on your premise for your business into your self-managed super fund, and your rent lands in super tax-free, which is a really exciting part of this strategy. With some investments, such as investments in private companies, there is a limit where you can't exceed more than the 5% of the fund's assets. That actually doesn't apply to commercial property. So commercial property can be a much higher percentage of the fund's assets. It just depends on the investment rules of the fund in the trust deed and the investment strategy. And finally, this is a really important one because your auditor will look at this every year. There needs to be a documented lease, particularly if you're renting it from yourself. So if an auditor sees that you're renting a commercial premise from yourself, they're going to want to see a commercial agreement in place, and usually every 2 years, they're going to want to see a market rental appraisal on that premises as well, to make sure that everything's done at the arm's length basis. You can just go to the next slide, please. So, paying rent to yourself. You own a trading business. You need a commercial premises, as most trading businesses do. Rent and outgoings are fully tax deductible, and it reduces the assessable income of the business, which is usually at 25%. If your super fund owns that property, then it receives that market rate of rent into itself as well as the outgoings. As I discussed, it can be taxed at anywhere between 15 and 0%, and services the commercial LRBA debt. As the property equity grows, assets are ring-fenced from trading risks. So if you own your commercial premise in a super fund, generally speaking, not a hard and fast rule, but generally, assets that are in super for more than 2 years are considered not attackable by creditors. Depending on the situation, though, that might not be defense, but usually speaking, that's the way it works. Your capital growth, if you choose to sell it before pension phase, is taxed at 10%, which is approximately half or less now than what it would be outside. If you realise the capital growth on the asset in pension phase, the tax rate is 0. Another effective strategy using this is if you have a business that your children are working in, you want it to be a multi-generational business, and you want to pass on the premises as part of your estate, then assets in super can be distributed using a binding death benefit nomination and never form part of your estate. So it means that the business and the premise the business is operating out of can pass to the next generation and cannot be contested in family court as an estate issue because it never forms part of your estate. So that from an estate planning perspective for multi-generational businesses, that's a powerful planning tool. If we can just go to the next slide. Okay, so the structure is effectively the same on an LRBA with commercial as it is with residential. So we need a bear or holding trust to be established within our SMSF. We need to go out and get a non-recourse lending arrangement with a finance company or bank. And that's obviously dependent upon the SMSF equity position, usually 30 or 40%. It still has to be a single acquirable asset in the LRBA. It can't be multiple assets. During the term, the property can be maintained and repaired, but not substantially improved. So that's an important point. You can't change the capital nature of the business. So you can't change the capital nature of the commercial property. It's got to remain the same. You can maintain it and keep it the way it is, but you can't significantly improve it. So if you have a large block of land and it's got an existing building on it and the rest of it's hard pan, you can't really go out and build another 10 units on it. You kind of need to build the 10 units first, then transfer it into super. Other things to consider is a personal guarantee structure. Members may be required to guarantee the loan by lenders, but the guarantee must be drafted carefully to avoid breaching the non-recourse borrowing provisions. So that is a creditor to your business who attacks your business generally can't attack the assets in super because it's held within the LRBA. It's limited recourse. So basically the bank holds caveat over it and it's protected if the business goes bankrupt. So that's another benefit. If we can just have the next slide, please. So if we have a look at this, got an engineering consulting firm. They got $450,000 in super and they're currently paying 60 grand a year in rent, and they're enriching a stranger's equity. Okay, so then they're not helping themselves. So they have the potential to buy the premise that they're in for 900 grand. Their SMSF can then enter into a non-recourse borrowing arrangement once an LRBA is established. Once a Bears Trust is established, they can enter into an LRBA. So we're going to borrow 585 of the 450 in super. We're going to put $315,000 in of cash, and the super fund will now earn 60 grand a year, including outgoings. 15% on tax as opposed to 47, which as engineers, they probably have the top end of their income in the 47% tax bracket. After 10 years, it's basically the loan is fully repaid from rent alone. So 10 years down the track, you have an unencumbered $1 million property plus capital growth. Assume that's entered into at age 50. they're now 60, they can start a transition to retirement pension. That premise is now worth 1.5, they can sell that, pay no tax at all, even though their business has claimed a deduction on the rent for the last decade. So it works really well. If we can have the next slide. So the exemption is commercial LRBAs are alive and well. The residential ban didn't affect them in any way. The wealth loop turns a deductible business expense into additional super contributions. So you now have the rent going in plus your super guarantee. Structure matters, fair trust, non-recourse loan, arm's length, liquidity buffer, and all the compulsory things with everything else. As always, we will do, at no charge to anyone, a feasibility on the investment so that we can go through what the costs are, what your resources are to ensure that it's all done properly if you choose to proceed. So the final point, as with all of these, always do a feasibility study on this and involve us. Won't cost you anything, but it'll just make sure if you do proceed, obviously we know exactly how it's going to spin out before we start entering into putting deposits on properties. And that's it. Thank you very much, everyone.